G'day, welcome to Lunch Money, your online and social media home for workouts, capital raising and special situations professionals. And we have a very special guest today, is a capital raising professional, Andy Way from Semper Capital. G'day, Andy.
Hello, and thanks for having me, Nick.
You're very, very welcome. We did do this about a month ago, but we had technical errors, and whilst we had a great time at the Chinese restaurant where we were at with a wonderful live audience, it wasn't much
Nobody
fun.
could hear us.
Nobody could hear us. So that might have been a good thing, might have been a bad thing. We don't know, but we're going to give it a go again. Now we are in the boardroom of Tax Assure, who are our venue sponsors today. If you want to be a venue sponsor, then all you have to do is put on a plate of sangers and give us your boardroom. We'd love to turn the camera the other way because it's beautiful Sydney Harbour out there, but
very distracting.
We can't do exactly. Well, it's distracting for us, but unfortunately, technical issues. So, Andy, these days people talk about functional fitness, right? You don't just go to the gym and do bar curls anymore. It's functional fitness. It's fitness that's fit for everyday life, so you can carry stuff around, sit up and stand up, all that sort of stuff. So I've called today's podcast Functional Economics, because this is going to be economics that you can take home and you can use it every day to help you. We're not economists, of course, but we are fund managers. We lend to small business, and so we actually put economics into action.
Yeah, we're certainly at the coalface, and we see how it affects everyday people.
Exactly.
And everyday businesses, and I think that's very often different than the way the government looks at it.
Now, so you are technically a fund manager, and you're running a mortgage fund, and you're lending into commercial situations.
That's it.
You're not a bank, so a little bit like us, or a lot like us, I suppose. You know, obviously, if people, I've always said, if you want bank funding, go to a bank. If you want bank pricing, go to a bank. But if you need something done outside the box, then you talk to someone like myself or someone like you. If it's property related, of course, you might talk to our friends Tax Assure if there's tax debt related, and a lot of stuff that we see is credit impaired because of the tax debt.
Yeah, a lot of our clients are transitioning to the bank. They might have sort of COVID overhang tax debt, or partnership arguments and issues. And the banks obviously don't want to touch them during that period, so they transition through us. Usually our hotspots between 2 and 10 mil, which is where we actively play. So
between
that, about 2 and 10
2
mil.
and 10, yeah. It's nice.
It is. You get into the competitive space, you run out of steam with most lenders at 5. So.
Yeah, it's interesting you say that, because I find that we try not to do terribly much under 1 because there is just a swarm of these new lenders under 1, and we'll get to that about all of that. Look, we're going to run through the RBA's latest chart pack. Actually, is what we're going to run through. So the RBA publishes a bunch of charts. They call it the chart pack, funnily enough. They do that every month. It came out last week, so these numbers are very fresh.
Yeah, let's have a look.
Let's take a look.
Really, if you look at the mean point, our GDP growth is not too bad. We got a bit of a blip in the last quarter, but you know, there's no signs there in GDP growth. Australia at this point that we're headed for recession. We might follow, and I certainly think if you look at the US graphs and the UK graphs, they're much more advanced in terms of their downturn in economic growth. But we've seen that COVID modulation, but the mean GDP growth is still there. As an exporter of raw minerals and with an active Chinese market still, we're doing okay compared to others.
So look, what I've found interesting is that and look, we might get to it, but the unemployment data, I mean, the unemployment's record low.
Yeah.
So that's consistent with steady GDP. Yeah. But every time you turn the TV on, you know, the treasurer is talking about the economy, you know, headwinds ahead.
Well, the signals are there in the larger economies too. And I think we also have a fairly good intelligence arm that keeps an eye to China. And it's a closed economy. It's a managed economy. It has a peg. The UN pegs low. It's artificially low. That's creating some problems in its own domestic economy. When you look at the housing market there, a lot of the housing debt, about 36 billion, is tied to US denominated bonds.
Right.
If the UN staying that low, the cost of servicing those bonds has already doubled.
Yeah.
Right. So there's the housing market in China is seriously in trouble. And if the economy there slows, it doesn't have to go into recession for it to affect the rest of the world. They want to keep a 5 to 8% growth. They're down very much below that at the moment.
You know, we don't hear a lot of that about China at the moment because it's drowned out by news out of Europe. Listen, let's just have a look at that. So we've talked about GDP. Let's just have a look at the components of GDP.
We've still got relatively low interest rates here. Yes, we've seen a bounce, but it's nowhere near the normalization of, the 3% growth in GDP, and they want at least 2 points above that for deposit income. So 5% would be the normal cash rate. We're still at 2.6, so we're still some way to go.
Okay. Now our next slide is just the figures on household consumption. Now,
we've still got a long way to go in terms of you might have a look at the bank losses in a moment, and you'll see that they're very, very low, and that's because people are still sitting on some significant equity in their properties. The bite hasn't quite hit on the late buyers into the market, but I expect that as interest rates continue to creep up, the areas that have increased have seen the largest density of development and the latest movement of cycle of home owners will come under some pressure.
Yeah, I mean, I still can't help but feel that there are some, that there's just a lot of that cash from COVID is washing over, hiding some underlying issues. But you can't deny the numbers. So. Okay, well, look, and then we get into our next slide is consumer price inflation, which are you believing these numbers?
No, not really.
Do you think it's only 6%?
The way it's calculated has changed so many times, it's hard to keep up with it. It's a bit like the unemployment numbers. They've been politically manipulated for benefit. Certainly the feeling, I think, out on the streets is that prices, CPI is far higher than 6%, month on month.
Well, I'll tell you what, I just picked up a new car today. It was just a Mazda, nothing to brag about. But the interest rate that my broker managed to get on that was in the 4%, which is remarkable.
Yeah,
but inflation's at 6%.
Yeah.
So my car, I'm getting it at a negative interest rate of 2%.
It's crazy. And this, you get back to the risk return curve, right? And Mazda's pricing probably out of a facility, Nomura, somewhere from Japan, where interest rates are much lower.
Well, no, this is local. This is a domestic lender.
But I don't know if the finance is domestic.
Yeah, right. Well,
you don't know how their wholesale, the capital stack might be made up of overseas capital, but that's incredible.
Well, the other weird thing is that I've picked up the car for at least a couple of grand cheaper than what you could buy a used one from a couple of years ago. And as one friend of mine said, I should sell it and order another one. But but what's interesting,
futures.
Exactly. So we see that inflation's up, and of course that's got to impact interest rates. Like, to me, that's the early signs of where interest rates cannot be below 6%. For home loans, for argument's sake, if inflation's 6%, it's a negative interest rate.
Yeah, that's exactly right. And I think the other thing about employment is we've got a lot of enthused small businesses trying to get into the market after COVID again, get reinvigorated.
Yeah.
A lot of zombie businesses that are going to trip over at some point.
Yeah.
We are seeing from our side a lot of applicants that are going through business restructure. We've had 2 in the last month that were loans secured against property to clear tax debt, significant tax debt, but also to buy out partners. So people are having a bit of a rethink, You can't change bank with the tax debt, so it comes through us. But the partnership change, I think people are starting to re-evaluate their business friendships as well as their other friendships.
Well, it's very interesting. Yeah, we settled one last week where there was someone buying somebody out, but they were buying them out because. It's a long story, but the business was underperforming because of the other party. Yeah. And so, of course, because it's underperforming, it's got, it's not bankable. Yeah. Right? Well, but the buyout will be very successful. So
I ran into some guys from the receiverships and administration businesses who say that the business is starting to pick up.
Yeah. Right.
So that means banks and the ATO are starting to pursue debts or to close down businesses.
Well, look at this. We've got inflation up and
consumer confidence down.
Where do we go? Consumer confidence down.
And that's that. I mean, that's a continuous trend there. I mean, you've got a bit of a spike that accounts for, the recovery from COVID. But look, it's no better than it was before we went into COVID. It's actually fairly depressing when you take out that sort of blip that was provided by the comfort of of government support.
Okay, so we're seeing price inflation, right? Obviously, there's oil and gas. Everyone's talking about gas at the moment, and luckily we're going into summer and we don't need our gas. We do need our electricity to keep us cool.
Yeah.
But we'll see what happens there. But the next slide now is house prices.
I think there's been a lot of wet weather. There's been a lot of delays.
Yeah.
Getting just wood in for roof trusses, for example. A lot of supply chain interruptions that are really bitten into late developments, and possibly more to do with that. I still think we've got a housing undersupply. If we start taking 200,000 people a year back in through migration, then there's a good chance that the housing market will hold up.
Yeah, it's interesting you talk about the wet weather. I mean, and then there was obviously the COVID thing as well. I've got a client that we actually settled yesterday, I was pleased to say. And they're kind of in the infrastructure game. And they'd be on a road site. And and you need the paddle pop people, right, for OH&S. And if COVID had swept through the paddle pop people and they couldn't turn up, well, then the site's closed.
Yes.
And then they had all the rain.
So
there's no doubt that there's been compounding issues there. Okay, so
certainly no pressure from banks to look at. They're very, very well securitized, well spread asset classes across the board are well picked up by the institutions. So I think fundamentally the residential mortgage market is strong, and residential property strong. We're seeing also a quite strong uplift in industrial and commercial hubs, because we're trying to bring supply chain back into the domestic realm, right? So we're distributing our own commodities rather than buying in from overseas, which is helping that area. I don't have any particular fear about the housing market yet.
Okay, you don't have a fear about the housing market?
Not yet, no. And I think we'll need to reevaluate by the middle of next year, because if interest rates keep creeping up, we're going to see some of the late buyers in the market suffering, and they'll start to dispose of assets, and then it'll become a competitive down environment.
Let's have a look at this next slide.
You've got the blue, which of course is
bonds. That is domestic bonds. So basically, everything's nice, and then all of a sudden COVID comes along and the market is flooded with money printing, really. Okay, people, it's deficit spending and money printing,
which is costing the government a whole lot more because interest rates are going up, right? Let's not forget that.
All right, now I do want to see what we've got. A comment here from Adam Lyle. He's punched it. The Treasurer has already come and said that we can't afford the planned tax cuts with inflation now at levels, the economy not yet slowing significantly. Surely we should be planning for tax increases within the next 1 to 3 years, given the extraordinary federal debt levels, which does need to be paid. Well, I would take issue with you there, Adam, because the trouble is that the tax, if they don't have the tax cuts, it's sucking money out of the economy. It's a political question, really.
It's a balance, because if you increase the taxes, then of course you decrease the money in circulation. And money needs to be in private hands, really, to grow an economy and keep the economy afloat. But it's going to cost more to keep supporting these bond issuances.
Well, let's look. I mean, my comment to Adam.
Generally, want to drive productivity. I might just say the best benefit is in driving productivity, rather than increasing taxes. But if you can't drive productivity, you've got a problem.
Well, the point that Adam. I guess the underlying issue behind Adam's point is governments have got themselves into this horrible mess, right? That you can see here with all the RBA balance sheet is chock-a-block full of domestic bonds. So those domestic bonds is government debt. So the RBA has gone and purchased all these government bonds, which is how money is created, right? And but we've got inflation. So they want to bring in, the debt's a problem because as interest rates go up, they've got to service the debt. You've got inflation. All the levers have been taken out. Now let's see what this has done for the UK. Now let's see if I can if I can manage to get this little video to play. What's going on?
Walking into a storm. The Chancellor arriving in Washington today for meetings at the International Monetary Fund.
What happens after Friday when the Bank of England stop buying bonds?
What's the matter for the governor?
It's a matter for the governor. But the governor of the Bank of England says it's now up to investors to get their houses in order.
So talk us through your understanding of the situation.
Okay. So these are unfunded tax cuts that the UK government has sought to stimulate the economy. So giving those at the top end of the tax bracket greater liquidity to invest in businesses is their idea. But it's unfunded, which means they're going to have to borrow that money from the markets. That has caused the pound, the bottom to fall out of the pound. It's pushed up the cost of borrowing for the British government. These are unfunded tax cuts. So they're reliant on the secondary market, the purchase of these government bonds by the institutions. And the institutions are saying, look, hang on, you're not such you may lose your rating. These bonds may not have the same sort of attraction to us that they once had. They're not as secure as they were. So the Bank of England says, well, we're not going to buy them back. We can't keep buying them back.
But the thing is, though, this is massive, right? So as you say, it's like if you go to the market and you buy fresh apples, and they're delicious and crunchy, but eventually all of these bad apples are finding their way to the market. And so the price keeps coming down. And I guess, what's happening is that, as you say, that the market in the UK is being fed these gilts, as they're called.
Yeah.
But the problem there is that the pension funds, or the superannuation funds, because interest rates are so low, the only way they're able to make returns to pay the retirees, people like when you and I in 30 years' time we retire.
Well, they're not going to buy
But what's happening is the only way they can get a good return is with leverage, right? So but now the pension funds are getting margin calls.
Yeah, but
and the Bank of England saying, the Treasurer, the Chancellor, there's check whatever it's called, is saying, well, get your house in order by Friday.
Yeah, but also they'd rather buy seasoned debt, right, which is inverted now. So they're trading, the face value of those bonds is trading down, but the yields are up. Therefore, they're getting a higher rate of return on the seasoned debt than they are on the new issuances. So look, it's a shocking situation.
Well, but the thing is, we had Lehman's, right? Was a big deal.
Yeah.
Well, these UK pension funds, that kind of sounds like a big deal to me too.
Yeah, you're dealing with people's current and future money. It's a dire situation for the UK. It really is.
Well, everyone's chasing yield, right? Yeah. Everyone's chasing yield. So it's not enough to have money in the bank anymore.
Yeah.
And so. You and I've been doing this for over 10
greed
years.
Greed has overtaken fear.
Well, greed is okay. I mean, I'm with Gordon Gekko. It creates markets, right?
Yeah, you temper it a bit though, because
exactly
there's no rationality for the risk pricing in some of the markets.
Well, I've got a little graph here, which is the risk return.
Yes,
but where really rates to reflect risk need to be higher.
Yeah, that's right. In fact, we're just releasing an investment product which is sliced by LVR, so it does exactly that. Those that want more asset coverage will get a lower rate, but they're well covered. But those that want to take the higher positions will get overpriced risk, right? And that's a good way to reflect, I think, how the market should perform. But at the moment, you've got in the market people paying too much interest and investors getting too little interest, and neither know which is which. We've still got cheap money in the market, but we've got some inherent risks that are entering. We're entering a very, very uncertain period globally. Here we're a little bit cut off from it, but what's happening in Europe is dire. Ukraine and food supply, food security has never been weaker. But, we've got some agricultural loans in the market, and we've got people making money hand over fist now because they've got rain. Yeah. They've got the cattle, beef prices are up. Sorghum wheat is selling well, wheat prices are doubled.
Okay, so just talk about, because not a lot of lenders won't touch agri for
Yeah.
all sorts of reasons.
Yeah.
You know, it's regulated in terms of getting your money back and all that sort of stuff.
Mm.
But are there certain agri sectors that you like and that you see, you know, in the context of the broader economy? I guess we're talking about, you know, obviously supply chains for food are
Yeah.
disrupted with what's going on in Europe.
Yeah.
So what are you seeing and what do you like?
Like I say, wheat, beef, top of the order at the moment,
Yeah.
and we have got actually three great wheat growing areas. We've got WA, South Australia, New South Wales. You know, beef all over the country, frankly, because it moves it to fattening stations, even if it's come from the bush. And we don't see beef prices or wheat prices coming down in the short term. And most of our borrowers are transitioning, as I said, to a larger institution, and for one reason or another,
Right.
coming through us.
Yeah.
But yes, agri is quite strong. What you don't want to be lending against is the margin operators. So somebody that has an orchard of lemons that ordinarily can't sell to Woolies because they're not good enough quality,
Right.
but all of a sudden supply chain issues are of a concern, so their second grade lemons are getting sold. Of course, that's not going to be the case forever. So you've got to look at the longevity of the market you're dealing in. But we are fortunate to have Costa family as our majority owners, and they understand agri.
We have fruit.
They know fruit. They certainly do.
Yeah.
And so we do take advantage of the knowledge we have in that particular space.
Yep. And why are these agri deals crossing your desk?
You know, it's interesting. We're just looking at one at the moment, a fantastic, profitable farmer whose bank facility has been misunderstood. He's lost his manager. He's south of Tamworth. He's being managed out of Brisbane.
Beef?
Beef and wheat and chickpeas and barley for winter. And the facility was supposed to be rolled into a longer term facility, and instead the bank said, well, you owe us that extra $1 million we gave you back now. Why don't you sell some cows? He said, but they're calves. You can't sell them.
Right.
So it's the lack of understanding in the banks about them. They don't understand the bush. The people that did understand the bush have gone.
Right.
And decentralization, and it hasn't occurred. So you've now got you've got 25-year-old bankers with concerns for their bonuses, with increased risk weighting being applied to agriculture at a time when agriculture in Australia is booming and where land prices have tripled.
Well, the thing is, though, a lot of agriculture has been corporatized to the extent. What I mean is there's big investment in agriculture.
Yeah, there's
right?
huge.
I mean, some of the wealthiest people in Australia, literally, are invested in agriculture. So you've got the corporate ag. I guess that are doing the big dollars.
Yeah.
And then I guess you've got the sorts of the smaller guys are being overlooked to some extent, aren't they?
To a large degree, and they're very, very strong businesses. One of the things that doesn't happen here and does happen in the US is the corporatization of the land, because land values go up. Particularly in times where you've got poor food security. There's no transition for the younger farmers coming through. They can't buy the land, so they lease it from leasing corporations.
Right.
There's room for that to grow here in Australia because land prices have, as I said, tripled. Whereas 20 years ago you might pay $1,000 per acre for productive land in the Riverina, for example. You're now paying $6,000. In 20 years, 6 times. The youth coming in can't afford that. So we will see a corporatization of land banking for agricultural use. That transition is inevitable.
Right.
And hopefully institutions then will become the owners of that and investors in it and allow farming here to thrive. But it's not been treated well recently.
Right. Okay. Okay, and what about? Let's just finish off our slides, and then I've got some more questions for. So this one is lending rates. So lending rates came down, but lending rates are going back up again.
Yeah.
So there's no doubt about that. Well, people with fixed home loans, etc. But even equipment finance, my equipment finance brokers are saying that some borrowers are hesitating at higher rates.
Yeah, there's a bit of rate shock. Because some of the better borrowers are suddenly faced with, if they're taking advantage of opportunity, they don't understand. And we've got some land bank loans still out, legacy loans in the 5%, right?
Right.
Whereas if we were looking at that deal today, it would be in the 7s. certainly.
Right.
Because the appetite of investors is they want to keep ahead of the yield curve, right?
Yeah.
But yeah, look, I think those very strong borrowers are saying, well, why am I paying so much? There's certainly a bit of rate shock there. But the banks there is going to be a credit starvation. One of the things that happens when government debt gets expensive, and when tax has got to be divvied out amongst the increasing cost of servicing, they want to bring that cost down. They stop the term funding facilities, they stop the repos in the bank, they reverse the quantitative easing, and all of a sudden credit becomes very expensive or starts to dry up. We're expecting there to be a real tightening in credit for the next year. And that's going to play to private lenders.
Yeah. Well, I guess it's interesting because certainly we've seen an increase in our deal flow.
Yeah.
Right.
As we have.
Yeah.
Yes.
And we've had a couple of good months. So after a tight time through the sort of COVID. Look, I mean, we're here at Tax Assure. They specialize in tax debt negotiation, and we find them very good. Sometimes you've got someone who's got a tax problem and they need to raise some capital to maybe fund a turnaround plan that involves paying some tax debt, and sometimes the assets aren't there to cover, pay the tax debt and fund the growth going forward. And so you need these guys to come in and do a bit of tax negotiation for you.
We work with them. Maybe if there's a docker in play and there's assets, then we fund out the docker, hand it back at the end when it's concluded. So
what I'm interested to know is, I mean, we are seeing the tax department, people, there is pressure there.
It's waking up.
Yeah, you're seeing that in the stats.
Yeah,
so you're seeing that as well.
Absolutely. The taxman is coming calling.
And that's a driver of deals for you?
Yes, it is. It certainly is. And as I said, particularly when it comes from somebody that has had multiple companies, and some of those companies have suffered during COVID and they've had to shut them down. But that legacy tax debt is still there, and they don't want to wipe it out, walk away from it, because it affects their ability to continue running the other businesses. So we're seeing a bit of that.
Now, I've said, I'm not, lots of people have said that if there is going to be some sort of distress in the markets, we're going to see it in the bond market, right? So here we have the corporate bonds, and the yields are, they've just
look how close they were.
Yeah.
I mean, this is when people don't understand that risk reward basis, right? You've got your AAAs in the red, and you've got the black in the triple Bs. So what you can see is the spreads between the strong bonds and the weaker bonds during the GFC widening, but they've kind of followed along, and now you've got some crazy issuances, short-term issuances exceeding. The bond market is nuts, absolutely nuts at the moment. You can expect the spreads to increase. They're going to have to.
But what we're seeing here, though, is obviously as the yields go up, the capital values go down, and so bonds are falling in price. Now they're not
inverse yield curve.
Well, they're not exactly collapsing.
No.
But there is obviously you look at what's happening with the UK pension funds, where they're leveraged into their investments in gilts, in sovereign debt.
These are collateralized. They generally are collateralized corporate bonds, right? So they're not just uncollateralized borrowings by companies. Generally, they've got some underlying asset value.
You reckon?
Yeah, well, they have to for the AAA, not the Bs, but they may not be collateralized. But even when you see, I'm not going to mention the bank issuing bonds previously at 6% return when we were at 0.10 in terms of cash rate. And they've got this convertibility into equity without any understanding of what that ratio of convertibility is. It's a trash bond issued by one of the big four. It's ridiculous, and people suck it up.
Well, again, there's weight of money chasing yield. But it's creating, it's creating its own problems. Listen, our last slide is this one here. Bank non-performing assets. Now
we're okay there because we're sitting on large amounts of equity, right, and some cash liquidity through the COVID period. So we're in a paradise period, and that is about to invert.
You would think so, but people have been predicting that. It's a little bit. Was it Oscar Wilde?
But we got a perfect storm. We've got a perfect storm coming, right? So we're going to have a credit crunch. It has to come globally.
So let's see what happens by Friday. If everybody hasn't got their house in order.
Yeah, that's right.
Fancy that. You get your house in order.
Yeah, you get told
Friday
by the Bank of England. Get your house in order. It's ridiculous.
Jolly good.
Yeah, and the lunatics have taken over the asylum there.
But if you look at this, now, if we were sitting here, I guess in 2006, we would be looking at this chart and we'd be going, look at that. Back in the recession we had to have, which was the early 90s, late 80s.
18% interest rates,
all of
5% margin.
You had, non-performing assets were, pushing up to 8%. That is massive, right? And then it came crashing down, and then you had this wonderful period, I guess, from the late 90s into 2006. You're sitting here in 2006, 2007, and that graph is bottoming out.
Well, that's GFC. You've got that.
Well, then the GFC comes along, but even then, it doesn't even hit 2%, right? No. So it was a quarter of as bad as it was in the recession we had to have. Now, I've always said the GFC was nothing. Didn't touch the sides.
Yeah. I mean, really, what happened was the great giveaway, I called it, by the Labour government, ended up being an inflationary factor in the market, which caused the RBA to lift interest rates for 6 months. So it was house owners and their mortgages that ended up dampening the market, and that's why you see that sort of blip there. They jumped in too soon with the support package then, not during COVID. I think that was fairly well handled, but the markets are still awash with capital. We're the fourth most liquid market in the world, so we domestically can raise funds fairly well, as the UK can. But as interest rates go up, it's inevitable you suffer mortgage stress, and you will then see banks' non-performing assets creep up. It's just an inevitability, and it's part of the credit cycle.
I guess, we had dot-com bubble. I'm just thinking of the little things that might be the blips.
That was 1999.
Yeah. So, and then we had, so there's been low interest rates for a long time looking at that graph. And we haven't seen anything like what we saw in the late 80s. As I say, like home loans within the 15%. And I've said before, I was at AGC, our property development loans at 23%.
Yeah.
And if you were putting up a block of apartments and not selling those things bloody quick, you're in deep trouble at 23%.
There was some economic mismanagement here, because at that time interest rates were around about 7 in the US and the UK and through Asia. So it was fairly isolated.
But I tell you what, though, I mean, I was around at the time, and I remember, Paul Keating describing the economy as effervescing.
Yeah.
He said you have to understand the economy is effervescing, and that's why interest rates were going up. And you could say the economy is effervescing at the moment. We've got record low unemployment.
According to the latest statistics, the
according
way
to
that
the
they're
latest
calculated.
stats.
But you've only got to have a job for an hour to be classed as.
But I was right. I think Jerry Harvey was out the other day saying it's all going great guns for retail.
Yeah. Look, it's the big spend is on, but these credit cycles are natural. Yeah. And there will, as I say, I do expect there to be a credit crunch, but we have a certain isolation from the rest of the world in the sense that we've got something that our neighbours in Asia want. Our raw materials are always going to sell, and as long as they keep the yuan as cheap as it is, they can have plenty to buy. That's on the plus side for us. But China could implode. I don't know how they can roll on when they've got greater than 300% debt to GDP, and that's just the debt we know about. It's not in the secondary banking market. It is the fear. If China folds, if the government can't keep selling land to banks that want to fund people that want to buy it, then their housing market leads them into the same sort of recession that Japan went into. Then we will suffer here as well.
Now, how are you? We're now in October.
Yeah.
The Christmas decorations are up. There's
Christmas music's playing in Manila.
There's fruitcake and
since August.
I think Aldi's having its Christmas deco, special buys coming up. what do you see running into Christmas? Do you see?
I think people are ready to celebrate the first open Christmas. They'll be scratching around. I think retail will be strong leading into December. I really do. I don't think anybody with a house that doesn't need to sell is not going to. The property market will just sort of stay flat. I think.
Right. And what about in your own business?
Yeah, well, we're very busy. And generally, leading into this part of the year, developers are trying to finish things. We're seeing the whole spectrum, right? So we've got overspend on development, looking for MES, and we don't do development funding per se at the moment because we feel it's out of cycle.
Yeah.
But if we've got close to development, we will look at MES. We have residual stock loans because developers can't sell them quick enough, and the bank wants out. They want their development finance back.
You're seeing a bit of that?
Yeah, we're seeing a bit of that, and an increasing amount of that. We don't mind residual stock loans. So
just to explain that for those that aren't necessarily in property development. So, the block of apartments has gone up, for argument's sake. Some of them have been sold, but a lot of them haven't been sold. Yeah. The bank wants its money back. The bank funded the development.
The developer wants to take advantage of buying cheap property somewhere if he's expecting it to come up.
Yep.
So he comes to us for patient money while he sells down slowly.
Yeah. So rather than fire selling the property,
that's it. You've got to allow them the patient sales, and not get nervous when they don't come. Just sit and let them turn.
Yeah.
We're seeing. But what about you? What are you seeing?
Yeah, we've probably seen more inquiry in the last, since July of this year. We've seen more inquiry, in some weeks than we'd seen for 2 years.
So since the government stopped funding businesses that should be borrowing,
you're
getting back into it.
Yeah, I think that, everybody knows now the ATO has been sending out thousands of notices to businesses saying that, that if they don't bring their tax up to date, the debt will personally attach to the directors of the business. And my understanding is that the ATO, rather than the ATO seeking to wind up companies, they're seeking to that threat of your company tax debt attaching to you personally is causing people to have a look and exactly all of that. And my understanding is that the banks are having less and less appetite. They developed a little bit of tolerance for tax debt. It's But my understanding is that tolerance, if you've gone to the bank and you've got some tax debt, that tolerance just isn't.
It's an absolute no.
Yeah.
We're seeing really, really strong borrowers with plenty of equity not being able to transition or pay out that tax debt. They go to the bank says no way. So they transition through us, pay the tax debt off, then back to a bank. It's crazy. I don't understand.
Well, I've got one it landed on my desk yesterday. It's been approved conditionally by two banks, a major bank and a sort of a second tier bank. But in both cases, the deal came to a grinding halt because of tax debt. And the tax debt, they're under arrangement. They've been paying it. And again, I think that maybe even a year ago, that might have been tolerated, but that's a business that's been around a long time. Its numbers are good. It's buying another business, so it's a business acquisition. The numbers are good there, and that's.
I can give you a good reason why the bank's non-performing assets are low.
Yeah,
they've got non-performing assets. They're not collecting them. The securitization market has dried up. They do not want the record of selling off people's property. It does not look good in their portfolio. So they'll hang on to it as long as they can.
Yeah.
So as long as there is residual equity broadly across their portfolios, people that are non-performing or underperforming are being coached.
But don't they have to report that to APRA?
Yeah, of course they do. But as long as they stay within the underperforming rather than non-performing, then they'll do that. Or they will work out with another lender that will take them off their books to remove it. So, we don't like picking up. We don't do any NCCP lending. So ours are all business loans.
Yeah.
That doesn't mean we won't in the future. But right now, you don't take a loan off a bank that's going to cost somebody more. We take loans off people that cost that are higher interest rate and happily do it every day of the week. But you don't apply somebody with a higher rate of interest and expect them to perform better.
Well, no, I've got a saying that we want to solve the problem, not become the problem.
Yeah,
and the other thing is I want to solve the client's problem, not the bank's problem.
Yeah,
the bank's very happy to get their money back, but unless you're solving the client's problem at the same time.
In 20 years, we've had 4 MIPs, which tells you we work with the clients, right?
Yeah, yeah. Okay, look, any messages for brokers?
Yeah, well, if you're not involved in commercial lending, it's not as difficult as you think.
Yep.
And we'll help coach them along, because brokers are probably going to see the residential lending market slow, but the commercial market will stay strong. So we run peer programs with well-established brokers that will help bring them along, but it's certainly something that they should think about doing.
Okay, very good. All right. Well, Andy, thank you very much
No,
for
thank
coming
you,
along
Nick.
again, and
Thanks, mate.
we'll do it again.
Always
I
a
think
pleasure.
maybe every few months we should trot wheel those numbers out
Always good.
and see how they go. All
Absolutely.
right. Cheers. Thank you very much to our live listeners and to those who subscribe to our podcast and listen later. Take it easy. Cheers.